Alright everybody, welcome back. So in this video, we're on video 9, or part 9 of the weekly options series, and we want to talk about the diagonal trade. Now this one is something that really gets people confused, but let's just kind of walk through it and talk it out a little bit. We've got two different expirations, and we're moving in two different directions with the options. The trade will actually expand with volatility, and that's why the broker won't give you a max profit, max loss scenario. Okay, so let's just first maximize the volatility so that you can really see how much it's going to move when volatility goes up. Now, we would not see this kind of expansion, so this is unrealistic representation of what could be this trade. But I just want you to see that when the volatility goes up, the trade expanded a lot. Okay, and the same would be in reverse. If we was to get vol crushed, it just wipes everything out. All right, so that's a very drastic representation of what volatility would do, but now we can see it. Now this red line is the expiration value. The green line is what we could expect to see. And I'm going to start moving through time. Now remember, these are two different expirations. The first one is going to expire on the 6th, and the second one is going to expire on the 8th. I need to close the July 6th before the expiration. I can hang on to the July 8th because that's the one that I bought, but the one that I sold is going to expire first, and we cannot hang on to a naked option or an option that we sold all by itself. We need to always have one of those in a spread, right? But I can hang on to an option that I bought all alone. So let's just move through the time frame here, and you can see that that green line is starting to form the shape of this red line. And now I'm going to bump the volatility up. So here you can see the max profit now is at $200, okay? But what I'm risking in the trade, my max loss, it didn't go up. So if you're getting into one of these and you push the button and the broker doesn't want to tell you how much your max loss is, don't get scared and think, oh, this is like some kind of unlimited max loss. I need to avoid this. No, not at all. In this example, we have a $1 wide trade and we're collecting 13 cents. If I was to round that down and say 15 cents, then I'm risking 85 to make 13. And if I just stop my mouse there, you can see the max loss is $87. 87 plus 13 gives us the $1 wide right here. So I know what my max loss is. That won't change no matter how much volatility comes in or goes out of the market. Okay, so don't let that bother you. It's the max profit that actually can expand or contract. Even in the contraction, it will never get lower than $13 at expiration, okay? Because in this example, if the market just completely falls and crashes and burns to the ground, you're still going to get to keep that $13. So let's take the volatility back out and watch this red line go back to its original position. And this is the value, this is the beauty of putting on a diagonal, that if you put it on and you get volatility working with you, you can get a really nice payout without putting a lot of risk into this trade, right? I don't want to lose $87, don't get me wrong. I'm not suggesting that it's nothing, but we can manage this, right? When you start to see the rally and hear the news and recognize that, oh man, this isn't looking so bearish after all, bail out of that thing. No reason to hang on. The trade that we have here is a trade that we want to use after price has made a deep, hard, fast run. Okay, let's go look at the chart for a moment. And what we're looking for is something that has made a very hard, fast, parabolic move to the upside. When a market makes that kind of run, more often than not, it pauses there and perhaps even fades a little bit for 1 or 2 days, It stabilizes, it finds some support, and then it begins to continue on. It's in that fade that we're looking to take advantage of the trade. And for these weekly options, what we would normally do is when price gets to the edge of the expected move, we put on the trade and we look for price to work its way back down inside of the expected move and get our position. Now remember, when price goes down, volatility goes up. And when volatility goes up, this trade expands in value. It's exactly what we want to do. Now, the volatility isn't going to explode like I demonstrated here. It won't be that drastic. Well, it more than likely shouldn't be that drastic. If it is, well, that's good for you. But that's unrealistic, right? This $13 trade could easily pay you 100% profit. And I know you might be thinking, yeah, but that's $26. That's not very exciting. No, but that's easy to hit. Okay. Now, the red dashed line right here is the break even. So we would need SPY to stay below 313.65. If it did that, then we're flat. We didn't win, but we didn't lose. Anything below that, we start to see profit. In this peak right here, that's $71. So you risk 87 to potentially make 70, right? And we know getting that peak, that apex, that's impossible. You would have to hold it moments into the close on the day of expiration, playing chicken with price, and that's just unacceptable. And it's unrealistic, right? But we can look at, maybe 1/3 on each side of this and say, okay, well, that's more realistic. Somewhere between 3085 and 312.5, yeah, I could hit that $4 range. And if I did, I could be looking at around $50. All right, so you're collecting a credit to get into the trade, and you will collect a greater credit if you happen to hit the right spot. This is a time-based trade, so you do need price to be in the certain range at a certain time. That is true, but it's a very short duration trade. So the idea would be that you get into this, and perhaps in the overnight or uh, first thing at the bell, that the market fades back and lets you out of this trade very quickly, and then you move on to something else. You don't want to expect to sit in this for 2 or 3 days. You get in, you get your points, and you get right back out again. So one thing that I want to point out is when you can, you want to build it for a credit or as close to zero as you can get. Maybe you pay a $1 debit, maybe you collect a $1 credit, either one. And the reason for that is if you can get this as close to zero as you can, more often than not, you'll reduce this side as well. Now, 1-to-1 would be perfect. If you could get it $50 here and $50 here, or 100 and 100, 75 and 75, if you can do something like that, hey guys, that's beautiful. But it's very hard to do. Typically, the volatility is not on your side. You can't get the fit. It won't line up. And if you just sit there and keep struggling with it, you eventually just get this contorted mess and you have to wipe it all out and start all over. Don't let the 10th get too far away. Realize that we're talking about looking at SPY falling $2. If it's been bullish, it could get that $2, but we're not looking for it to get, $7, $10, $12. You know what I mean? That would start to put us into like a bear market, and all we're doing is looking at a price that made a drastic, sharp stab to the upside and stall. And in that stall, and perhaps in a bit of the fade, we get our profit. There's many ways to play this fade, by the way. I just want to make sure that I do cover this trade because there's a lot of things that you can do with a back ratio or a diagonal. there's ways that you can use this later in other trades and other products. Get familiar with the multiple time frames. Remember we're talking about a bullish market. So in this trade, you're selling a call and you want to see price fade. And that call, you can see the one that I have here. The one that I sold is July 6th. Well, that's Monday. And this is the last day of the market, which is uh, it's July 2. We're closed on July 3, and then we have the weekend. So when the market opens back up, we're going to be July 6th. So we're talking about if I had pulled the trigger on this trade today, when the market opened on Monday, at the end of the day, this option would expire. And I would be looking for SPY to fade off in that one day. And I need to get rid of this trade. It's no kidding. That call is done. But I can keep the one that I bought. So I would still have the 312 in play. And that's a call that I own. I bought it. So I want to see the market move back up. If it looks bullish with that gentle fade and we can sell out the call, hang on to that other one, and then you get to ride it up and take profit with that. Okay, now this one's only 2 days apart. So, to lock in profit, if during the day on Monday you get out early with the one that you sold and now you're just in a call, the market starts to make its rally up as it does sometimes after lunch and gets a pretty steep run to the upside, you could then look to sell a call in the 8 series and put yourself into a spread at that point. Not this spread, but just a regular spread. So many ways to be able to manage a trade like this, way beyond just putting it on and looking for that fade. This isn't something you really want to play around with for a swing trade, like a 30-day or a 60-day trade. There's so many other ways that we can do this kind of play where we don't lose if we stall and we don't lose if we fall. And there's ways to do that. The main value in this trade, the sweet spot, so to speak, is that in the current market environment, the market makers are very heavy-handed with the implied volatility. And if SPY was to drop $1 or $1.50, they're going to whip that implied volatility on there, and it's going to expand this red position. Well, when they do that, it's going to help you. It increases how much money you can make. Okay, so that's the beauty of it. We could easily find a trade that makes money when price falls $1.50. That's not the problem. But we don't want to put on just a regular spread because the regular spread wouldn't expand with the volatility like this one will. It's the little tricks of the trade. All right. So in the weekly series, this diagonal is the way to go. So let's just go build one of these real quick. We have the 8 and the 6, the 11 and the 12, and we're on the call side. This is not a trade that you want to do on the put side, running it in the other direction. Okay. So we got the 11 and the 12. Let's just go ahead and delete that trade and go back to the analyze and copy this trade. That way, we got it all put into place. So, sell the 11 and buy the 12. So here's the 6, the 11, and we want to sell that, and we want to buy the 12. Just like that. Now that doesn't look the same. Maybe I'd screwed something up, huh? Are they in a different series? We got the 8, the 6. I don't like it when it does the things like that to me. Let's do it one more time. Sell that one. Buy that one. Nope. That's the one. We'll throw it over there and look and see if it's the same thing. What changed? 312. Call. It's unlocked. No, it's not unlocked. Ah, that's it. All right, so the trade wasn't unlocked. You got to make sure you unlock those things. That little thing right there, screw you up every time. So this trade, everything's still good that we talked about. Only in this one, If it falls too far, we're back into loss. We're at minus 33. So we want to make sure that we get that closer to zero or above zero, and then we try to minimize this loss back here. So let me just pause this for a minute and readjust the numbers. Okay, so here I've got closer to a 1-to-1. We got a 176 and a 124. It's not exactly a 1-to-1, but a lot closer. Now notice how much loss there is here. It's 176 to the downside, and that's because it's a $3 wide trade. Now I can bump it up to a 10. Now there's $2 in here, and we're looking at a 157 and a 43. We're not close to a 1-to-1 anymore. All right, but we still have that tent and that sweet spot that we're looking for. It would still expand with the implied volatility, and if this distance looks too far, which it does to me, if I saw SPY fall $3, I would expect to look to make money in it other than this kind of trade. So I'd really want to start shifting everything forward at this point. Maybe run to the 15 there and a 12 or a 13 there. Now there's the zero that we were talking about earlier. It's $1 credit, and the tent, I moved it too far. The tent literally is right at price. We want to see price actually fade a little bit, right? So maybe somewhere around that 311 would be a better spot. So we knock that to a 14, maybe this to a 12. Now that tent is just shifted. We're still on the left side of break even, but the tent is a little farther down, and the 310 is still within our range of a good spot. Right? We've got $13 of credit if the market just continues to fall, which I wouldn't expect SPY to do unless things just got really bad. And again, better ways to make money, right? It's this side which is concerning, the 187 to the upside. So in this trade, it is the call that you sell that is the one that needs to get your attention the most, because that's the one you have to close first. You can close the whole thing at once. You don't have to leg out of it, as I've been talking about. But if you're still bullish on the market and you're only expecting a $1 or $2 fade to last 1 or 2 days, this is a great trade. So then you get out of the one you sold, you keep the one you buy, and you look for the rally out. But what do we do with this? What do we do with all this loss? Right? That is where the concern is. So a hedge or some other trade added to SPY can cover this side. But this is a trade that when you're building it, there's a lot of different opportunities or a lot of different things that you could put on, and trying to find that exact spot, the spot that works best for you, can really eat up a lot of your time. You can really mess around in here a lot and not quite ever find exactly what you're looking for. So make sure that you spend time doing this outside of regular hours, or at least outside of when you're trying to get filled. Don't wait until you actually need to use it before you go and try starting to build it, because it is something that takes quite a bit of practice to do. You really want to try to get this side smaller. Now, we've got a $2 wide trade here, so it's not going to get very small, right? And if we can't get that smaller, then we need to try to make this side bigger. Try the different opportunities down here. And again, it's not about looking for a market to fall. This is just, it's there, but if the market was to move that far and that hard, we would definitely be wanting to look at other trades, and we wouldn't even be concerned with this trade. You know, that's not the point. We really want to either hit this 10 or be out of it, because we don't want to be messing with any of this. All right. So let's move the date back. This is my current date now, July 2. And you can see that if we did rally forward, we had plenty of time to get out. You know, no way we would sit in this, even for very long at all, because we're expecting a market to have hit an area, stalled, and begin to look for a bit of a fade. So there's no ambiguity here. If you see the market still looking strong and still looking bullish, you don't put this trade on. And if you do put it on and then it starts to look that way, you get out of this thing. Don't hang on to it and start to risk this kind of slant. Okay. So that's it, guys. That's the diagonal for the weekly spread. You can put it on in the Qs and IWM and DIA, absolutely. And you can use it in equity products. I don't want to imply that you can't. You will find that it's hard to put on to get this minimized side if it's something that has $5 wide strikes or $10 wide strikes. It's going to make it a lot harder to do. So if you can find things with $1 wide strikes or even 50-cent wide strikes, then you're going to really have a lot more opportunity and choices to deal with this side of the trade. I appreciate your time, and I'll see you at the next video.